We are seeing a classic conflict between fundamental strength and political uncertainty. Despite a powerful kickoff to earnings season from Wall Street's heavyweights and the semiconductor industry, the major indices stalled this week. The question smart money is asking right now is not whether earnings are good. We already know they are. The real question is whether the market has already priced in near perfection, leaving it vulnerable to a pause or rotation as regulatory headlines take center stage. This is your weekly market review for the week ending Friday, January 16th, 2026. Let's look at the tape. After weeks of persistent upside, the market finally paused. The S&P 500 finished the week essentially flat, closing Friday just under the 6,940 level. What we saw was a clear tug-of-war, strong earnings momentum pushing higher, and technical resistance near the psychologically important 7,000 mark pushing back. Neither side fully won, which is often how consolidation phases begin. The Nasdaq 100 showed more visible weakness, sliding roughly 1% on the week to close near 25,500. This was not a story of collapsing fundamentals. Instead, it was selective profit-taking in the mega-cap technology names that have led this rally for months. Investors were willing to lock in gains, even as the earnings headlines remained constructive. The Dow Jones Industrial Average also drifted lower, finishing the week down about 0.3% near 49,360. Here, the drag was more concentrated, coming primarily from financial stocks, which brings us to the dominant theme of the week: execution versus regulation. We officially entered the heart of fourth-quarter earnings season, and by most objective measures, corporate execution has been strong. However, the market reaction told a more nuanced story. Good earnings no longer guaranteed higher stock prices. That divergence suggests institutional positioning was already crowded going into the season. When the good news arrived, it created liquidity for distribution rather than fuel for another straight leg higher. The most important macro development was not an economic data release, but a policy headline. Reports emerged around a White House proposal calling for a temporary cap on credit card interest rates at 10%. Regardless of whether such a measure ultimately advances through Congress, the introduction of headline regulatory risk was enough to change behavior. Institutional managers did not need certainty. They needed a reason to reduce exposure. This dynamic weighed heavily on the banking sector and underscored an important reality for 2026. Policy risk is once again capable of overriding fundamentals, at least in the short term. Let's drill down into the key movers because the sector-level message was clear. Start with financials. We heard from J.P. Morgan Chase, Bank of America, Wells Fargo, Goldman Sachs, and Morgan Stanley. The universal banks delivered solid results, beating expectations, but their stock reactions were muted. The overhang came from consumer-facing exposure, particularly anything tied to credit cards or retail lending, which suddenly carried new headline risk. In contrast, the pure-play investment banks told a different story. Goldman Sachs and Morgan Stanley reported strong results driven by a rebound in mergers and acquisitions, equity underwriting, and capital markets activity. This reinforces a thesis that has been quietly building for months. The deal economy is back. Corporate confidence is improving. Boards are transacting, and capital markets are reopening. Institutional flows are reflecting that distinction, favoring capital markets-driven franchises over consumer lending exposure. Now, to semiconductors. Taiwan Semiconductor delivered a genuinely strong earnings report. The company beat expectations and guided toward elevated capital spending levels, reinforcing the view that demand tied to artificial intelligence and advanced computing remains robust. The market rewarded the stock, pushing it to fresh highs. What mattered more, however, was what did not happen. Despite the strength of that report, the broader semiconductor complex failed to accelerate meaningfully. NVIDIA and several peers saw only modest follow-through before stalling. When a sector leader delivers excellent news and the group does not rally in unison, it often signals short-term buyer fatigue. This does not invalidate the long-term AI narrative, but it does suggest the market is digesting the valuation expansion of recent months. Looking ahead, the calendar introduces a brief pause and then a potential inflection point. U.S. markets are closed on Monday, January 19th for Martin Luther King Jr. Day, which should keep volumes light early in the week. When trading resumes on Tuesday, attention shifts back to the consumer and the next wave of earnings. Netflix will be one of the first major technology bellwethers to report. As a high beta, sentiment-sensitive name, its results often influence broader risk appetite. Any signs of slowing subscriber growth or cautious guidance could reinforce the narrative that leadership within technology is narrowing. On the economic side, retail sales will be closely watched. Bank earnings have given us insight into the consumer's balance sheet. Retail sales will tell us how that consumer is actually behaving. A meaningful downside surprise would reintroduce growth concerns that have been largely absent from the market conversation. In sum, the market has entered a prove-it phase. The easy upside from the pre-earnings rally is behind us. From here, higher prices require not just beats, but guidance strong enough to justify elevated valuations in an environment where policy risk has re-entered the equation. Pay close attention to how stocks react to good news. If strong earnings continue to be met with selling, consolidation likely has further to run. If prices stabilize and absorb the headlines, the broader uptrend remains intact. I'll see you next week.